Amazon is down 50% year to date. It's had horrible performance in 2022, and it doesn't seem to be getting better anytime soon because even over the last month, it's down another 8%. Over the last quarter, down 28%. And the funny thing is, this 50% negative performance in 2022 doesn't even factor in the all-time high. If you look over the last 5 years, you can see at one point this company actually hit an all-time high of 188, which doesn't even factor where it was 1 year ago at around 170. So the high from peak to trough just 2 years ago actually takes this company down about 56%. So that is not good for a company of Amazon's size. And it's rare to see companies of this market cap go down so much because this originally was about a $2 trillion business that's now only worth $900 billion. Now, despite the revenue going up, this has been good. Amazon is still growing. The profitability has faltered. It's gone into the negative, and what was originally putting up many profitable, high-level $15 billion plus profitable quarters are now putting up many quarters that are in the negatives or even negative tens of billions of dollars, and it doesn't seem to be getting better anytime soon. Furthermore, we see articles like this. Amazon's once red-hot web service business extends hiring freeze for most teams in 2023 and targets low performers. We're going to talk in this video why I'm not worried about Amazon. If you didn't know, it's my second largest position in my portfolio. It could very well become number one very soon, depending on how I weight my portfolio going into the next month and going into 2023, but right now it's a big position of mine and I don't plan on selling anytime soon. We're going to go over in this video my spreadsheet for Amazon numbers and talk about what I believe is the most important segment of the business, which of course is AWS for Amazon Web Services. We're going to talk past numbers, future numbers, projections, spreadsheets, and all things in between, so it's going to be a fun one. Stay tuned, and without further ado, let's go ahead and get started with Amazon. But before we get into all that, we have to talk about today's sponsor, MooMoo. MooMoo is a new up-and-coming brokerage that is taking the world by storm. Commission-free trading, level 2 data, advanced technical indicators, earnings calendars to see the date of financial statement releases, and institutional tracking to follow Warren Buffett's portfolio are just a few examples of what MooMoo has to offer. With this being my first sponsor in the channel, I have fully vetted their company and stand behind their vision. MooMoo currently trades on the NASDAQ under ticker symbol FUTU for FUTU and is SIPC insured. If you sign up below using my special referral link, you can get anywhere from 1, 10, or even as high as 20 stocks for signing up when you use my special referral link down below in the description or in the pinned comment down below. Free stock amounts can be as high as $1,000, so sign up now using the link in the description or pinned comment down below. You would help support me and my channel by doing so and give yourself an edge in the world of investing. Thank you so much, MooMoo, for sponsoring this video. Now back to the content. Welcome back, and let's go ahead and start by looking at the top line revenue numbers for Amazon. This quarter was very good, 14.7% growth, but we have to look at each specific category of revenue growth, which you can see right here. Of the 14.7%, about 20% of it came just from their retail sales in North America, which is primarily driven by things like Amazon Prime numbers, their subscription revenues. There, of course, their physical stores like Whole Foods and Amazon Fresh businesses, and then, of course, the Goliath of their business, their e-commerce. Now, international revenue shrunk 5%, but this is mostly from foreign exchange. FX headwinds has been a problem for many international businesses this year, and Amazon is no exception. They are one of the main targets of this. As the dollar has gone up in value, international revenues are worth less. As the dollar goes up in value, foreign currencies go down. Now, Amazon Web Services, or AWS, did put up one of the worst numbers we've ever seen, pretty much the slowest growth it's ever seen. However, it's still incredibly fast at 27% year over year, which led overall a weighted growth rate at about 14.7%, which you can see long term here, matches up with around where the company is typically seen over the last 10 years. It's slightly slowed down, but you can still see it's growing well into the mid double digits, but this is expected to go down quite significantly going into the next quarter. While we do expect record revenues above this $137 billion last year, which is normally their big quarters in the fourth quarter, they only expect around the 140s or so, which is very low growth, especially for a company the size of Amazon. And you see negative articles like this, like Amazon Web Services starting to slow down, and it's true that 27% growth is slower than they used to do, but I don't want to talk in this video about the bulk of this revenue, because the thing is, this revenue is unreliable. It has profitability that goes up, and then it has profitability that goes right back down when we get into a recession. E-commerce and the selling and delivery of products is not a business I want to get into, because if we look at an example like a company like Walmart, it is a company that has perpetually low margins because they have extremely high overhead. If you look at the long-term track record of Walmart, you can see that they typically have profit margins at around 2 to 4%. Not very high at all, which means basically for every dollar of revenue they sell, they only get to keep about 2 to 4 pennies. The same thing can be said about Amazon. Now I think long-term they will have profitable margins at around 5 to 6% of their e-commerce, maybe even a little higher because it's more efficient than Walmart in my opinion. However, those are still extremely low margins. You can see that Amazon last year put its pretty much best number ever at 7%, which is not that high. But the profitability really doesn't come from these categories. It comes from AWS. Because if you look at the long-term operating margins of these segments, its North America segment typically does anywhere from about 2 to 5% profit margin during good times. And international is basically at a break even to negative 5% over the last 7 years. Meanwhile, AWS is running about 25 to 30% margins, and even in 2022 is running 30+% margins despite the recession. Now, something interesting I might mention as well about AWS is not only their revenue increasing, but their actual backlog. The amount of customers that are trying to acquire their services over a long track record, it's often more optimal for them to sign a contract that is longer than 12 months, which you can see right here. It goes from 21 to 25 to 30s to 40s to 50s, all the way up to the most recent quarter at $104.3 billion in the backlog. And this is only contracts that are longer than 12 months out, so who knows, that doesn't even count the current this year. But basically this company has contracted annual revenue of $100+ billion. And I think this is an important key to note here, because if you look, this is a perfect example of something that just happened a couple weeks ago. The Pentagon splits $9 billion in cloud contracts among Google, Amazon, Oracle, and Microsoft. And while Amazon didn't get as big of the pie as I thought they might, they still got over $700 million in contracts over the next 5 years. You can see it's $723.9 million to be exact, and I would expect this to go up over time, and they will likely keep this recurring almost as a certainty in my opinion. I'd be really surprised if this type of revenue ever went away for Amazon. And if you look at my projections long term, you can see that really the bulk of the projections come from AWS in terms of the profitability. Now in terms of the revenue, AWS might not make up as big as a pie as you'd want it to be, but that's not what we care about as investors. As someone like myself, when I'm looking for is free cash flow, which has been very bad for Amazon lately. Long term, I think it's going to be stellar. I think it's going to be outstanding. But the big part of the revenue here, if you look at this operating profit, look at this section I'm highlighting right here. If you look at the revenue, you see where it's split up. And this is both in a bear, mid, and bull case. And you see different projections for all three types of categories. But really, if you look at the operating profit segment, which is right here, and right here, if you look at these sections I'm highlighting, the AWS portion, generally speaking, in all three of these scenarios, make up around 70-ish% of the profitability in every single case, because AWS is really what you're buying here. I think that the first-party platform is very good, and I think it will expand their moat, expand their brand, expand their recognition among consumers, but really, AWS is where the money's at. And if you take any type of decent revenue or profitability multiple for what AWS will likely be in the future, if you assume even decent revenue and profitability growth for AWS, it's pretty shocking to see how big this company will get. Even looking right here, if you see where AWS did in terms of profitability last year, let's look at what it said. It said $18.53 billion in operating profit last year in 2021. Okay? Now keep in mind, so far in 2022, if you take the average of the 3 quarters, the company has been growing right around 30% so far in 2022. Now, if you look at these projections down here, this is the bear case that says Amazon Web Services will only grow 20% over the next 4 or 5 years. This is my projections going into 2026, so over the next 5 years. Well, if you look at what they're doing in 2022, so far you can see that they're doing right around 30% margins. Okay, so we know the company is growing 23%. Okay, so we know the company's growing 33% top line, and they're doing the margin that is already slightly beating what our estimates are for 2026. So this would assume the company would slow down growth dramatically, and the margins would never expand at all over the next half decade. Even in that scenario, AWS would produce $46 billion in operating profit, which is a far cry from last year's 18.5. That's about a 3x over the next 5 years, which is significant. So when I look at Amazon, I definitely want to see them continually expand their moat and get this revenue number up. But really, the reason why they're focused on getting this revenue number up is to expand their brand recognition for consumers and increase their long-term moat, their dominance basically across the whole globe. But the long-term profitability and the real story for Amazon, in my opinion, is AWS. It's not these little retail sales numbers, it's not subscription revenue. It's this section I'm highlighting right here with my mouse. This is where the money's at. This is where the profitability is going to come. And I think long term, as the stock price is faltering now, and it hasn't looked good over the last 5 years, going up only 45%, I think profitability one day for Amazon Web Services is going to be too big to ignore. So that's why I'm buying Amazon. That's why it continues to be the second largest position in my portfolio, and while I'll likely be increasing my position to my biggest holding out of my entire portfolio. Thank you guys so much for watching. Check out all the stuff down below in the description if you haven't already. But other than that, guys, thank you so much for watching. Thank you, MooMoo, for sponsoring this video, and I'll catch you all next time.